Good afternoon, everyone. Thank you so much for joining us this afternoon. I'm very excited for this workshop this week where we get to talk about everything that you need to know A to Z about reverse mortgages. So I'm very excited to have Richard with us. Richard, tell us a little bit about yourself, how you got to be in this industry, what's your specialty?
Thank you very much. It's a pleasure to join you today. And so my background is that I've been a reverse mortgage loan officer for 18 years. Started out with banks, and I'm now with American Advisors Group, AAG. So if you see Tom Selleck doing an ad on TV, that's us. As a reverse mortgage loan officer, I'm dealing with lots of the public. I'm dealing with lots of financial planners, elder law attorneys, and of course, realtors. So that's my background.
Very nice. Very nice. Well, I get a lot of questions and work with a lot of senior members in our community. And
Right.
I hear more and more is, Olga, we just want to stay in our home. This is where we have been living for the last 15 years. You know, we want to spend our golden years in our home. And besides making sure that their home is safe for them, which is our number one concern for seniors,
Yep.
I really wanted to talk to you about opportunities and talk about the details about what a reverse mortgage is, because I think there's a lot of misconceptions are out there about what this program does. I know that it's not right for everyone. So let's jump right in and talk about what is reverse mortgage. So tell us what it is so we understand clearly.
Real simply, a reverse mortgage is a mortgage for seniors where the two most prominent features are they're refinancing their property in most cases, but there are purchase opportunities as well. They're getting money based on the equity in their property. And the second and more important feature is that, or more unique feature is that they're not making monthly payments. So having given that small definition of what a reverse mortgage is, let me take a step back and pose and answer the question, why are reverse mortgages important these days? And you've touched on it, obviously. Many seniors want to age in place. Mm-hmm. And we've heard that, it's very common. We talk about a better retirement. So it's not just aging in place, it's more than that. But if we take a real broad view, what we're often looking at is the demographics, the big numbers. And excuse me for a second. And if you look at the numbers, there are approximately 73 million Americans over the age of 65. Somewhere between 5,000 and 10,000 people are turning 65 every day. 1 in 3 seniors doesn't have has no retirement or very, very little retirement money set aside. And altogether, there's over $7 trillion worth of real estate owned by these seniors. So if a financial planner, for example, isn't looking at the real estate when they do a financial plan for a senior, they're missing the boat. It's a big issue, a big resource, a big piece of equity that we're not looking at. If I peel back the onion a little bit, also look at it this way. When my father retired, he was a mid-level manager. He had some stock. He had a new, in those days, 401k. He had a pension. He had his medical paid for the rest of his life because he was a mid-level executive and so on. Today, we're seeing many, many people who have none or almost none of those resources going forward. Many people are living just on Social Security or Social Security and a small pension. And those are the people we're often finding most commonly are our customers. We increasingly are seeing people using the reverse mortgage as a financial planning tool. And I'll get into that in a little bit, but there are many, many applications that we address with the reverse mortgage. So let me do this. Let me talk in a little bit more detail about what a reverse mortgage is. First of all, I'm going to read this. AARP has a book called Homemade Money, and their definition is a reverse mortgage is a loan against the home that you do not have to pay back for as long as you live there. With reverse mortgage, you can turn the value of your home into cash without having to move or repay the loan each month. That's a basic definition. So we have several varieties of reverse mortgages. The one most common is what's called the home equity conversion mortgage. If you see ads on TV, it's almost certainly the home equity conversion mortgage, HECM. If you go to the HUD FHA website, you can find some details on the home equity conversion mortgage because HUD structured this. I think Reagan was the president who signed it into law, and HUD structured this many years ago. There are changes and updates and so forth to keep it current, but that is the most common reverse mortgage and the one I'll talk about almost exclusively. There are other reverse mortgages. We offer a jumbo reverse mortgage for properties of $1 million or more. I'm happy to talk to anybody about those if that's an area of interest. I do know that there are a couple of states offer a proprietary reverse mortgage. Other lenders have some proprietary reverse mortgages. Sometimes they're niche products and not the broad product that we're talking about with the home equity conversion mortgage. So it is a mortgage in every sense, like any other mortgage, in that there's a note, a promissory note. There's a mortgage, which is the pledge of the property. And then there's a lien against the property, which says that we hold an interest in the property, or a bank or whoever else is doing the reverse mortgage. The homeowner still owns the property. Let me be real clear. They're still responsible for property taxes, homeowner's insurance, and upkeep of the house or property. And then we can get into how the monies are dispersed, how much money a person gets, and so forth. But let me point out that the proceeds of a reverse mortgage are tax-free. It's not income. It's a loan against the property. And for those people who are looking at Medicare, Medicaid, in the state of New Jersey, things like PAAD or the STAR program and other benefits, these are most often based on income or they're, quote, means tested, end quote. And generally those forms of assistance or entitlements, whatever you want to call them, are not affected by the reverse mortgage. Let me mention one exception though. Medicaid, people can have Medicaid and get a reverse mortgage, but there are certain restrictions that go with it, like how much money you can take out of the reverse mortgage on a monthly basis. And it has to be balanced against how much money the individual or couple or whomever the borrowers are spending each month. I won't get into any more details like that, but understand that some of the programs, but not most of them, are affected by getting the reverse mortgage. And with that, I'll take a breather. Yeah.
Sure, sure. Well,
Yeah.
so let's head into, so this was a good overview, and I definitely want to pick your brain on some of the more detailed questions, even like we'll do like a hypothetical scenario. Is there any rule of thumb on what homes don't qualify for reverse mortgage? Can we do a condo, townhouse? Does it matter?
Very good question. Generally, most of the properties that people own are single family houses or condos, right? We get trailers, we get new construction and so forth. And a single family home is acceptable. A 1 to 4 family home is acceptable. A condo is acceptable with some conditions. Condominium developments are oftentimes approved by HUD,
Mhm.
but not always. If they're HUD approved, then we have no problems doing a reverse mortgage. We collect a little bit of information from the management company to make sure that they're keeping a capital reserve and keeping insurance and so forth. If the development is not approved,
Mhm.
we have another option, and that's what's called a single unit authorization, which means that if the buyer qualifies in terms of a really good record of paying property taxes and homeowners insurance and things like that on time, then we can have a single unit authorization for a reverse mortgage on a single condominium. If they haven't had a good track record in terms of paying their property expenses, taxes, homeowners association dues, and so forth, then chances are we can't do a reverse mortgage for them. Not for sure, the chances. So, did that answer your question? Sorry.
You did,
You were
you did,
asking what
absolutely.
topic.
So basically, I think what you're talking about is if there is an HOA involved, this is where you have some additional information and questions for them before saying yes or no, right?
Yes, yeah.
Okay.
And that would apply for single family residences in some of the, say, 55 and over communities where there's an HOA. We generally don't have an issue, but we do want to collect some information there as well.
Absolutely.
Just a little.
So can you give us some idea on this program, this reverse mortgage? Who is it right for? And who is it not a good idea for? Can we kind of break that down?
This goes back to applications.
Okay.
Which is sort of the, when I started out talking about 73 million baby boomers and so forth, this is kind of the getting to the heart of the onion after you peel back some of the layers. And I tend to look in three categories for applications. And those are seniors who haven't saved enough. And they just have a hard time. Seniors who have a sudden need. Let me say, for example, somebody who's fallen, broken a hip. Now that person is home and they need 24-hour a day care for, say, 6 months. Doesn't need like a couple where one spouse passes away and the income that was coming in from that individual who died is no longer available. So there's a sudden need there. A third category is someone who has an existing mortgage. They're making monthly payments, and the principal and interest payments obviously cut into the funds that they have available. So by getting a reverse mortgage, they pay off the existing mortgage with the initial funds, and then their monthly payments have gone away. That leaves them greater cash flow. A fourth category, is somebody who wants to use a reverse mortgage for financial planning purposes. We know that financial planners will sit down with their clients and say, how much money do you have? What are your assets? Okay, I'm going to predict how long you'll be in good condition, how long those assets will last you. And let's say your financial planner projects that a single person will make it to age 90. But oftentimes what they can't calculate or don't know how to handle exactly is what happens if there's a catastrophic health issue. Let's say somebody gets cancer, they're going for treatments for years. Some of it's covered, some of it maybe isn't covered because they didn't get a great Medicare plan. Then what do you do? Or let's say a person has long-term care insurance, but the long-term care carrier says you haven't met the requirements for to ADLs, or those activities of daily living, which is what triggers the long-term care insurance to kick in.
Right.
What do you do in the meantime? You know, so that's a financial planning. So it's used as a financial planning tool to say, down the road, I'm going to need some money.
Got it.
That brings me to the fifth application. Well, let me go back for just a second. So one of the features of a reverse mortgage that I didn't mention before is this. Borrowers can take the money in any one of three ways. They can take it as a lump sum. They can take it as a monthly distribution, which most people understand and expect. But there's a third way of taking the money that people oftentimes don't know about, and that's a line of credit feature. In other words, I'm 73 years old. I've got a $200,000 house. I get $100,000 for my reverse mortgage. What do I do with that? Well, I can sit on that in a line of credit. Use what I need when I need it. Now, if I'm still working, as I am today, I can sit on that line of credit. And there's a really, really interesting feature of that line of credit, and that is this. It grows at the same rate as the accruing interest on any monies that have been borrowed. So as a result, if I start out with $100,000 today, and I sit on that for 10 years, that line of credit in 10 years may be $160,000. So a financial planner looking at Mary Smith and projecting out to her 90th birthday says, well, there's a 72% or whatever it is probability that you're going to need some long-term care in that span. And so we're going to put you into a reverse mortgage. You're going to sit on the line of credit until you need it. So that's a financial planning aspect of the reverse mortgage. Let me go to the fifth application, because your question was, who's it good for and who's it not good for? And the fifth application is this. A senior who, let's say it's a couple, and they have a big house because they raised 4 kids. The kids are all gone. They don't need the big house. They want to either downsize or move to a 55 and over community. This is an excellent opportunity for them to buy a property with a reverse mortgage. Let me go back to that example I flew through real quickly. I'm 73 years old. I get 50% of the value of the property. Those ratios apply for a purchase as well. So if I go to purchase a $400,000 house, I may only need $200,000 in cash, and then I can finance with the reverse mortgage. And it works the same way. I don't have to make a monthly payment. So if I've sold a $600,000 house and I'm buying a $400,000 house for which I only need $200,000, I can pocket now $400,000 or invest it. Mm-hmm. So a purchase opportunity with a reverse mortgage is really interesting and exciting, and it's something that more and more people are looking at. So those are examples where a reverse mortgage would benefit somebody.
All right, before you go further, you froze up on the first one, which I didn't catch. So what was the first number one opportunity that
okay.
you catch?
So the first group of people that I look at are people who can't stretch a dollar for 30 days. In other words, they're living on Social Security and it just isn't enough. And that's been the bulk of our business for many years, but we're seeing it transition to more people who want to pay off a mortgage or a home equity line of credit, people who want to purchase. And frankly, people who want to manage their assets going forward and to have a better retirement. That cover it?
Yes, and
yep.
What you talked about is actually, it's pretty cool because there are truly different ways depending on where you are and how many assets you have to use this as a tool. Really, it can be used as a planning tool. So that's really, really cool.
Yeah. And people in New Jersey do things like buy a condo at the shore. People gift to their grandchildren. There are just a million applications, and there are some I'm getting way off track here, but I'm going to do this anyway. There are some tax implications that are actually kind of beneficial. So let's say a homeowner has an IRA, and it's growing and it's appreciating. And one day that homeowner passes away and there's a relatively large IRA with capital gains. Well, the interest that's built up on the reverse mortgage based on the monies that have been drawn now can balance against the capital gains in the IRA. I'm not a tax expert. I encourage everybody to talk to their elder law attorney about this stuff, talk to their CPA about this stuff, talk to their financial planner about this stuff. But there are some really, really interesting and detailed and unique ways of using a reverse mortgage going forward. Let me go back and tell you who it's not good for.
Yes, please.
Somebody who is moving. I just want the reverse mortgage because I'm going to fix up the house and move in a year. Don't do it. Somebody who calls and says, I need $30,000 to buy a car. My car just failed. Don't do it. If I can tell that person though, look, you need to do some advanced planning for your retirement. And as part of that, go ahead and buy your car. Then it makes more sense. But if all you want it for is a purchase like a car, there are some reverse mortgages out there, proprietary ones. In other words, they're not backed by the federal government. They're not insured by FHA. People can find those too. Who else is it not good for?
So you're saying for someone who is thinking short term, right? It's not good for someone short term.
I would say that. I would say it's not generally good for short term. On the other hand, I have upon rare occasion done a short-term reverse mortgage for somebody, for example, who needed $200,000 to get into a skilled nursing facility or an assisted living so that they could get the best possible outcome, so that they could get the best assisted living. And the assisted livings and skilled nursing facilities often are looking for a year or 2 years, usually a minimum of like 18 months of private pay. And so one time I did do a reverse mortgage for somebody who was anticipating going into assisted living in 8 or 9 months. And they got the money.
So that brings me to the question then, what would be the benefit of doing something like that if you can do like a easy explanation if that's possible versus what people typically do? They know how much skilled nursing is going to cost them per month. Most people just end up selling the house, or unless you're thinking that they're only going to need skilled nursing for a shorter period of time with the hope that the resident is going to come back home.
In this case, there was another family member living in the house, the example that I gave, and they wanted to stay and they needed some time for transition. They were going to fix up the house to sell it a little bit and so forth. The most common approach, I believe, is to sell the house. And there are firms out there that will do bridge loans to make that happen. And that's probably a wiser method of doing that. Yeah.
Got it. So let's talk about real examples, because I learned best by an actual example. So let's take example of your Mary, who is 73 years old. And hypothetically that Mary, in this example, does not have a mortgage, right? And let's say her property is worth $300,000. Give me an idea on how a home equity conversion mortgage would be structured. Like how much money would Mary get roughly, right? If we can talk about some numbers so people can understand exactly what that formula looks like.
I think Olga's just frozen for a second.
Oh, yeah. I'm here.
She's back. Start the example of.
Okay. Yeah, just give us an example of what the numbers would look like, right? $300,000 house, no mortgage.
and she's 73.
Sure. Let's use your example.
So I can't do these off the top of my head, but I'll give you a pretty good guesstimate.
Sure.
And let me back up a step. We calculate the amount of money somebody's going to receive based on three things.
Okay.
Based on the age of the borrower, and if there are multiple borrowers, we're looking at the age of the youngest borrower. And if there are multiple borrowers, the youngest borrower can be younger than 62, which is the minimum age for a reverse mortgage, if there's one borrower who's over 62. So we're looking at the age of the borrower. We're looking at the value of the property, which is eventually established by an appraisal.
Mhm.
And we're looking at the current interest rate. So in today's market, just by the way, the interest rates are extraordinarily low. In 18 years, I've never seen them this low. And the lower the interest rate, the greater the payout. Also, we see home values are very, very high these days. And I'm reading predictions that they're going to remain high for a little while longer, at least. And so going back to Mary, she's 73, interest rates are low. She doesn't have a mortgage to pay off. She's got relatively good credit. She's paid her property taxes and homeowners insurance on time. And she has a minimum amount of income. I'm going to make this assumption because the two qualifying categories that I didn't mention before, and I'm going to mention now, are what in the financial assessment. We don't look at credit scores, by the way, but we do look at people's credit reports. We look at whether they've made their property payments on time. And we do look at how much income they currently have because we're looking for a minimum amount. For a single person, their minimum residual income is only $540 a month. So it's relatively low. So this particular individual would get about 50% of the value of the property, and probably after fees and expenses. So 300,000, she's probably looking at $150,000. Probably, as most people do, that would be in a line of credit.
Okay. And does that mean that it works just like a line of credit? So you have like a checkbook where if you need to, you can write a check or pull whatever amount of money that you need?
Well, it's similar, but not quite. So it's a line of credit. You can draw, a borrower can draw from it, can pay it back. And as I said before, the line of credit is always increasing at the same interest rate as the accruing interest. We don't use checkbooks though, for a couple of reasons. One is many of the institutions that used to offer reverse mortgages, such as Bank of America and Wells Fargo, were what we call depository institutions. In other words, they'd have checking accounts, savings accounts, and so forth. But many of the institutions now that offer reverse mortgages are not banks, like AHE. So we don't have the mechanism to process 1,000 checks a day or 100,000 checks a day or whatever it might be. And so we have like any loan, there's a servicing department. Mm-hmm. And there's a request that's put into the servicing department for however many dollars you want, 1,000, 2,000, whatever. And then when Mary puts that request in, a couple days later, those funds are transferred by EFT to the borrower's checking account or savings account, either one, usually checking. And then they spend the money. So it takes just a little bit of advanced planning. You can't write a check on the spur of the moment, and you can't go into your grocery store. And there was a trial about 8 or 10 years ago where they did offer checkbooks, and people were going into the grocery store and writing a check for $12.80. Didn't work.
So let's say in our hypothetical example, Mary gets $150,000. That amount of money is given for a certain number of years. Is there a maximum number of years?
No. So a reverse mortgage is in force as long as the homeowner, or if it's a couple, at least one, remains in the home. And so that $150,000 would be available until that individual leaves. I'll digress just a little bit here because this is oftentimes a question I get. Well, what happens when my mother dies? Well, what happens is typically this. We get notified pretty quickly, even if the homeowner or the homeowner's family or attorney doesn't notify us, we get notified pretty quickly. And from that point, the homeowner or whoever has inherited the house or the attorney, or whatever, has 180 days to settle up on the loan. If the homeowner is making a genuine effort, whether they're trying to refinance it, maybe one of the children wants it or a sibling or something, if they're making a genuine effort, they can appeal for another 90 days and then 90 days thereafter. So a grand total of 360 days is possible to settle. Typically, people sell the property though and pay off the reverse mortgage.
Okay, so if Mary used all of $150,000 hypothetically and she passed away and the house is worth 300, the house gets sold, the reverse mortgage gets 150,000 and then the family gets another 150. Is that correct?
Close, not quite. So here's 150,000. Mary's been drawing it to pay her property taxes for all these years. The interest rate, let's say, is 4%.
Okay.
Give or take, you know, we've been around 4% or lower recently, and so 4%'s been accruing on the monies that she's drawn. So let's say she actually owes 225,000. The house sells for 300,000 because it hasn't appreciated in all the years. She let it get run down a little bit, whatever. So there's 75 that goes to the family or the attorney or the church or wherever she leaves it in her will.
Okay. What you're saying. And also, is the interest accruing on the line of credit or only on the amount of money that you already took out?
Let's be real clear. The amount of money that's drawn is accruing interest.
Okay.
The amount of money in the line of credit is growing. So the example before where I said somebody might have $100,000 in the line of credit, and at 4%, at the end of a year, they have $104,000 if they don't use it. At the end of 2 years, they'll have $108,500 because it's compounding and growing over the years.
Got it. So my next question, go ahead.
Let me go back and change that example you just gave me a little bit.
Sure.
Let's say Mary drew the 150,000. The interest was accruing on that. And we're suddenly in an economic downturn like we were in 2009. Let's say she owes $275,000, but the house is now only worth $250,000. He's underwater.
Right.
This is one of the things that people were most frightened about with the reverse mortgage. And so the home equity conversion mortgage, the FHA product, has mandatory insurance that it's mandatory. So you have to pay, as a borrower, you have to pay into this mortgage insurance fund. It's 0.5% on the monies borrowed, plus an upfront amount. But you're paying into that fund. So now Mary has passed away. The house is underwater. The family takes the keys, they put them in an envelope, they write this, they fill out this form. It's called a deed in lieu of. Send it off to us. We hand it off to the federal government. The federal government says, okay, we're going to have to pay $25,000, the shortage. And the family goes, thank you very much, goodbye. So we don't want the heirs, the children, anybody else to have to bear the load of any overage. So this is what's called a non-recourse loan. We have no recourse to come back to the homeowner and say, hey, you hit the lottery. We know you've got this money, pay up. We can't, we don't do that. So somebody who does really well with their IRA, for example, but the house is now upside down when they leave, we can't touch it. We can't touch that IRA. And they've sort of beaten the system.
Interesting.
I shouldn't say that, but you get the point.
Yep, I
Yeah.
get it. And is there, when you said 50% of the property value, is that typical? Does that mean that you cannot get more than 50%?
No, it's a sliding scale. Remember I said the payout is based on age.
Right.
So if I get somebody who's 90,
Mhm.
in today's interest environment,
Mhm.
they're looking at about 75% of the value of the property.
Okay, so that was my next question. So the older you get, the bigger payout you have.
That's right.
Based on, because you have a shorter lifespan left, right?
Right.
Got it. Okay. So the younger you are, the less money you're going to get, but the youngest you can be is 62 years old to be able to use this product.
That's correct. Yep.
Got it. Okay. So let's talk about what you mentioned as an opportunity for someone who has a mortgage now and they're making monthly payments. How does that all combine and fit in and makes a good decision for someone?
So what it does, quite simply, is if, going back to your example of Mary, if she's eligible for $150,000 and she had a mortgage of $100,000, the first $100,000 of the funds available to her go to pay off the old mortgage.
Mm-hmm.
So let's say her principal and interest on that mortgage was $800 a month. Well, there goes $800 that was coming out of her Social Security check every month, or her pension check or whatever, that now is freed up to pay for gas and groceries. Let me give you another example. This is a real life example. A couple that I met down in Spring Lake. So they have a fairly valuable property. Called me about a reverse mortgage. And they were in their mid 70s at the time. They had a country club membership, et cetera. They were living well. The house was worth, I don't know, $750,000, something like that. And they had a mortgage on the house of, I think it was $150,000. So they were eligible, given their age at the time, they were eligible for, I don't know, $400,000 or something. So the first 150 went to pay off their existing mortgage. That freed up enough cash that they told me that they used that difference then to pay for their country club membership. Good for them. And then the remaining monies in the line of credit would grow, so they had that cushion going into the future. By the way, this guy worked for a very large, very well-known Wall Street financial firm. He was pretty savvy. And the fact that he understood this and basically was telling me how it worked was really eye-opening for me. It was fun working with those folks.
Okay. And one of my last questions that I have is, why would someone do a reverse mortgage? Let's say it's Mary, age 73, versus doing a regular line of credit on a home? Because, you know, right now you can get 75 to 80% line of credit on your home, and that is put on and you don't pay any interest until you start using the money out of your line of credit. So when would you say it might be one thing maybe better than the other and vice versa?
There's actually research on whether people would choose a home equity line of credit or a home equity conversion mortgage. And what they did was they said, here are the characteristics of these two loan products. They didn't say which was which. They didn't give a name. And people overwhelmingly chose the reverse mortgage. But it boils down to this. A home equity line of credit is often proposed by financial planners as an emergency fallback. What happened in 2008 and 2009 was, and it's happening a little bit today, I've heard, is that the lenders the banks that are issuing these reverse mortgages. Cap them, call them, cancel them. Because they have that, if you look at the language, they have that ability.
Right.
So, you know, an emergency happens like 2008, 2009, I've lost my job, whatever, and I need 100,000, I've spent 50,000, boom, they close the door on me at 50,000. What do I do? So it's not necessarily the best solution for somebody going into retirement, because a reverse mortgage has none of that ability for us to cancel it out, like we were talking about before. Mary gets to keep that reverse mortgage until she moves out of the house or passes away. But the other more obvious point is this. If I get a reverse mortgage, or if somebody gets a reverse mortgage, and they start making, you know, and they draw a little bit of money right away, well, then they start making payments right away. That's sort of contrary to the whole notion of a reverse mortgage. A reverse mortgage is fundamentally based on the notion that we're providing funds to seniors without the necessity of them making a payment the very next month to pay it back. So that's the biggest difference, and why and why we think that a reverse mortgage is a better tool to use. One other thing is this. Somebody who's in their 70s, let's say, or 80s, and applies for a home equity line of credit might have a harder time getting it based on their income. So it's not available, not necessarily available to people who most need the reverse mortgage.
Excellent points. Absolutely. You bring up excellent point.
Yeah.
This time I wanted to actually open it up for questions. David, Beverly, if you guys have any questions for Richard, you're welcome to either put them in the chat box, or you're welcome to unmute yourselves and ask away if there's something else that we haven't covered.
For sure. Thanks a lot for the questions so far and all the information. It's quite interesting. I feel like I understand a regular line of credit or the regular amortization for like regular loans, but with this discussion here, everything is flipped upside down and reversed. It's really something else. So let me ask one question. So it was just mentioned about the people, or I wrote down, there's 3 things I wrote down. It's the age of the borrower, the youngest borrower, and then the value of the home and the interest rate. Are those the 3 things that determine the payout amount?
That's correct. Yep.
And like, what about health? Like, what about the health of an individual? Like somebody could be really sick, or someone could be really healthy, that the banks don't really take that into account.
We do not take that into account. And we do, we've done a number of I've personally done a number of reverses for people who have dementia. And so they're being cared for by family members, let's say, or severe health concerns. You know, those are people who really need the reverse mortgage. And so it would be kind of counterintuitive to not provide them the funds that they need.
And you know, this is huge, because these are the major health issues and concerns that prevent people from getting long-term care insurance.
Okay. So this factor, yeah, it's like an example of a good option that should be at least considered for people who need it.
I think so. Yeah.
Mm-hmm.
Yeah. So let me clarify one thing about the way the money works on the numbers. So with the example of Mary, it looks like she'll, it's kind of like it's an upfront agreement. It happens. That's kind of like probably similar to like a closing. And it seems like she'll be agreeing to like, give half of her home to the bank in a sense, right? 150,000. Is that part of the whole deal? Is that the correct way to think about it? So she's kind of like agreeing, you know.
Yeah. Okay. Let me answer it this way. First is the number one myth about reverse mortgages is that the bank owns the house.
Okay.
And I worked for banks for many years until I joined AAG. And I used to say, darn, if the bank owns the house, introduce me to the vice president who manages all those properties, because I want a piece of that action. The bank does not own the house.
Right, right.
More specifically, though, Mary gets $150,000, she doesn't need to use that money. Let's say she ends up using 50,000 of it. And the line of credit remains at 100, and when she passes away, there's still $128,000 in the line of credit. That line of credit reverts to the equity in the property. So when the heirs or the attorney or whoever sells the property, we only take the amount that she's borrowed plus the interest on that amount.
So what happens with that other 150,000? Like there's the well, the home value is worth 300, and you were saying that there's no mortgage, so that means that to begin with, she owns the whole entire home for 300,000, right? To begin with, or before anything happens.
So before the agreement, before entering into the reverse mortgage, she owns a house. It's worth 300,000. We get only the monies that she's borrowed plus the interest. So any other equity in the house, including any appreciation over the years, goes to her if she's gone to assisted living, or her estate if she's passed away.
Oh,
Does that
okay.
answer your question?
It's just starting to. So I was thinking there was like a loss of 150,000 up front, and then the potential to gain a little bit of interest, like 4% interest if you sit on the money for the remaining 150 that's in the line of credit. Okay.
That 150 in the line of credit simply represents potential borrowing. We don't take it, we don't draw it out, we don't have an account that says, here's 150,000, we're going to now take this and dole it out to Mary. It's just the potential for her to call us, send us a note, whatever, and request those funds.
Okay, so maybe then what would happen? What would happen after the end of like 10 years? Can Mary sell this home? And what would be the situation there?
Yeah, absolutely. Mary remains the owner of the property, so she can do anything she wants. There's no prepayment penalty, by the way. So if she says 6 years down the road, I'm feeling good, but I hate the cold weather, I'm going to sell this place and buy a place in Florida. Bye-bye. Nice knowing you. We can help you with the purchase in Florida.
Right.
Yeah, she has full ownership, so she has every right to do whatever she wants with it.
Okay, so then it's really if the home value stayed exactly the same, then it would be 300,000, and then she. I'm thinking, how would you explain that part? I understand that along the way, if she draws money out, then she pays interest on that. Is that really the only way the only place the bank would make the money would be on the interest related to the drawing of the money out?
No, that without getting into the weeds a whole lot, we oftentimes, most times, will charge what's called an origination fee.
Okay. Oh, sure.
I do, and the paperwork and the staff.
Equivalent of like closing costs or any associated fees.
Yeah, they're closing costs. Yeah.
Okay, but that's at least that can be known up front and all that. Okay.
We have to divulge that on the good faith estimate, so you'll know. You'll have any borrower would have a pretty good idea, very close estimate of what is going to be charged up front. And those funds almost always just come out of the proceeds of the reverse mortgage. Occasionally we'll get somebody who's, say, younger, whose strategy is to sit on the line of credit for a number of years and have it really build up. And so and maybe they're working, and they'll say, you know what, I'm going to pay all the closing costs out of pocket so that I have the maximum buildup over time of that line of credit. But usually they come out of the proceeds.
Okay, and then one other thing that Olga said at the end there, it made me think, I just want to make sure I understand the payment part. So if Mary draws out some money, say she takes out $3,000 in the first month, she would then be charged, say, approximately 4% as the example. She would be charged 4% interest for taking on that amount of money taken out. So would it be kind of like $3,000 times the 4%, that kind of number?
Right. Per annum, yeah, divided by 12, and that's monthly, and
okay.
Monthly statement as such. Yeah.
And is there another direction that money is going in? Because that's, or is that it? Is that the only type of, you know, for a regular loan, that's kind of how it works. It would be, well, the idea with the regular loan is you can make extra payments and try to pay it down earlier. I think with the reverse mortgage, what you could do is you could hold out and don't draw the money. Is that what the idea would be? That's the equivalent of the exact opposite, like just holding out.
Yeah, and some people, particularly those who are working with a financial planner, where the financial planner is savvy enough to figure this out and say, you know, you need to be prepared for a catastrophic event down the road. They just sit on that and they just let the line of credit grow and they never draw. Some people draw it, and occasionally, I had a guy who owned a restaurant a number of years ago, and he drew the maximum amount out of the line of credit, and then he started paying it back because he needed it for his restaurant.
So there is no restriction on what you can use the money for, right?
Correct. No restrictions.
Okay.
I had a borrower one time who had his bags packed to go to Atlantic City as soon as he closed. He wanted that money to go gamble. We don't recommend that, by the way.
Right.
Yeah.
Do you have another question, David?
No, that's pretty good. I was just going to go along with that. So the idea would be, right, you just have to think about the person, the interest rate. No, okay, I'm starting to get a handle on it. So in general, when I've heard people mention it a couple of times, like, oh yeah, you don't want to do a reverse mortgage. I don't recommend that. Like people will just make that kind of general statement. But today you're pointing out that there's a lot of options. So in all of these scenarios, the person has to be at least 62 years old. Is that the idea?
At least one borrower has to be 62. Yeah.
Okay. Well, like, I wonder if people get into like working with their parents, you know, like my parents are older than 62 and that kind of thing.
Since you mentioned that, let me mention something else. I work with, like I said before, financial planners and CPAs and trust and estates attorneys and elder law attorneys and so on. And one piece of advice that I give them to give their clients is get your parents off your payroll. And the reason I say that is because there's research that shows that's I think it's just under 15% of people between the ages of 40 and 60 are actually financially assisting their parents. It's a pretty large percentage. And if you're in that age group and you're sending mom $1,000 a month to keep her afloat, you know, that's cutting into your retirement, your children's education, whatever. Whereas they probably should be considering a reverse mortgage and use the house to pay for their retirement.
Okay, that's interesting. Sure. So in terms of myself, though, because I'm only in my late 40s, I can't really do anything at this time. All I can do is just learn about this and be aware of it, right?
Yeah, it's not for you yet. It's for your parents, perhaps, but not for you.
Right. Okay. By the way, I used to work in Seagirt. Did you mention, you know, Spring Lake? Or I think I looked you up briefly on the internet and mentioned Seagirt. Are you somewhere in that area?
My office is in Seagirt.
Okay.
I've never been there.
You've never been there. Oh, wow.
So I work out of my home office in Bridgewater, and but I cover the entire state. And for many years, when I worked with a bank that had branches all up and down the East Coast, I went as far south as Florida when it was necessary. But generally, New York, New Jersey, Pennsylvania. These days with American Advisors Group, I'm licensed in New Jersey, but one day, not too distant future, I'll be licensed in Pennsylvania as well.
Okay, I live in Pennsylvania.
Okay.
We have resources from Richard that handle reverse mortgage in PA as well, David, if that's of interest to you.
Oh, thanks a lot. And then the only other thing would be sometimes I've looked online for like a calculator, for a reverse mortgage calculator. I never really found one.
Really?
Yeah.
Huh. You can definitely find one at our website.
Okay.
And it's pretty simple. They're just going to ask age, value of the property, do you have an existing mortgage, things like that. So aag.com. And I know that our competition also has them.
Sure. Yeah. But I just looked casually a few times. and
Yeah.
find it.
Usually you'll get bombarded by offers if you just plug in reverse mortgage.
Yeah, sure.
You
Yeah,
do-
I've done that for regular loans, and yeah, and then
and half of them will have a reverse mortgage calculator right there for you as well.
okay.
But if you're ever curious, I'd be happy to run the numbers for you as well.
Okay, thanks.
And we do things like we'll check if you call up and say the house value is probably 400,000. I can go into some of the professional services that value properties before even going the next step, and get some of these values. And sometimes it's eye-opening, sometimes it's not. Homes and developments, for example, senior developments, we have a pretty good, you can go to Zillow and ePraisal and get pretty good estimates. But but a house, just a single family residence somewhere out in the neighborhood, we might be able to get a better estimate for you.
Mm-hmm. Okay, that makes sense.
Yeah. Let me go back and mention one other thing. I did say that in order to qualify, people need to have paid their property taxes and mortgages and things like that on time. If they haven't, it doesn't mean we can't do the reverse mortgage. But oftentimes what will be required is what we call a life expectancy set aside. It's kind of like an escrow account projected into the future, where we carve out some of the proceeds of the reverse mortgage in order to pay the taxes and homeowners insurance. We can do reverse mortgages for most people who come to us with either of those conditions, but not all. And so it is, it's not an automatic thing. And it's, by the way, it's definitely not a government benefit. That's one of the myths, along with the bank owns the house and it's only for people who have no other resources. FINRA, which is, I can't remember what that stands for, but F is financial and the R is, I can't remember what it stands for at all now. FINRA is one of these organizations that monitors financial advisors. It came out a few years ago and said it's not a product as a resource of last resort. It's really it has a broader application, which I think we're seeing, and hopefully we're getting that message out better today than we were a few years ago. Okay, any other questions anybody else has? Sorry, I'm getting notices. If you hear the dinging, I'm getting email notices.
No, I think unless Beverly has anything, but I think we did a really good job about talking about everything that we need to know. So what I will do is I will provide Richard your contact information. I also think that I will add the reverse mortgage calculator link to this video as well.
Good.
I appreciate you spending an hour with us this afternoon. This is really interesting, and I appreciate you dispensing some of the myths and truly helping us understand that this is an excellent product for a lot of people. They just need to ask some questions and do the research. This is where, yes, the legwork is on the families as well as on the seniors to do the legwork and to ask the questions to see if this is the right move for them. So I appreciate it. Any last parting thoughts before we sign off?
There's a lot more detail. If people have questions, I'm happy to answer questions about things like what if the house is in a trust or a life estate or things like that. I work, like I said before, I work with attorneys. I get a lot of support from them for those sorts of things. But I didn't talk about the process. For example, there is a process which requires that borrowers go through counseling, but it's simple. It's done by phone. It takes 45 minutes and so on. So point simply is that an hour, we covered a lot in an hour, but there's still a lot more to go if anybody has any more interest.
I'm sure. All right. Well, thank you so much, everyone, for chiming in. I will provide Richard's contact information. Yeah, Beverly?
No, I was just saying thank you. I'm calling from Canada, and I'm not sure whether it's the same thing, the reverse mortgage, whether it's actually the same way it is like it is in the States. I'm not sure.
Beverly, I don't know much about reverse mortgages in Canada because, as I pointed out, this is a product in the United States that's backed by the Federal Housing Administration. But I do know that every once in a while I'll see a headline that says that reverse mortgages are available and growing in popularity in Canada. So you might want to check with your banks.
Yeah, I'll do my research. Yeah.
And I think they work generally the same way, but I'm not really qualified to speak to that. Okay.
Okay. Thank you.
Good luck.
All right,
Beverly.
well, thank you so much, everyone, for tuning in. Richard, thank you so much for spending an hour and sharing your knowledge with us. I very much appreciate it. And everyone will send out the link to the recording so that way you can listen to it again, along with a couple of resources that I jotted down. I'm going to put all the notes in the box so that way you have them handy. All right.
Thank you for the opportunity. It's been a
All
pleasure.
right, my pleasure. Thank you so much and have a great day, everyone. Bye-bye.
Take care. Bye,
Thanks.
everyone.
Bye-bye.